world. Now we're gonna talk about um, venture capital, VC, and unicorn economy. Professor Bonaparte, director for a master in FinTech. If you're interested in masters in FinTech, great program. Director for external affairs means I work with the industry and try to meet them and help our students. The learning objective for today is understand the role of venture capital VC, examine how VC funding create unicorns, the link between VC and unicorn, analyze VC structure incentives, and explore behavioral valuation dynamic. Behavioral is big in this industry, VC and unicorn. What is that? A VC, venture capital? Private equity invested in early stage, high growth startup. Objective, capture outsized return from innovation driven risk. Model, high risk, high reward. And structure its LPs, institutions, endowment, wealth individual, GBs, VC firms, managing funds, and equity. Now, what's the VC ecosystem? The key players are entrepreneurs, founders, angel investors, venture capital, corporate VC, accelerate and incubators, limited partners, support network, legal, marketing, technical mentorship. What's the VC funding ladder? You stage by stage, if you will. Pre-seed angel accelerators, 50 to 150 to 500,000, concept validation. Start with the seed then. Early VC funds about 500 to 2 million, product market fit. Series A at institutional VC, 2 million to 15 million, scale up. Series B and C, which is growth funds, 20 to 100 million. Market leadership, then you start having fear, a purpose. And Series D, much before the IPO, it's a late VC, PE, 100 million expansion or IPO prep. So, power law of VC return, 1 to 2 startup produce over 80% of total funds. That's a law of in this business. Most portfolio companies fail to break even. So they're not always, you just need 1 or 2 to do very well. Example, Sequoia, early investment in Airbnb, WhatsApp, Stripe, strategy, high convention, asymmetric bet. The economics of venture capital, VC fund life cycle, about 10 years, 1 to 3 investment phase, 4 to 7, like develop the product, 4 to 7 growth and scaling, 8 to 10 exit via IPO or sometimes pre-acquisition, like a Google go and buy this company and then get them off from the shelf. Return usually 3x to 5x over the fund life. Management fee 2% annually. Carried interest about 20% of fund profit. How VC create unicorns? Because we focus on unicorn in this class. How VC support that? Provide capital and mentorship and network. Accelerate scaling via recruitment, board access, media credibility, customers. Example like Anderson Horowitz, Coinbase, Robinhood. They just venture capital, speed up, especially Robinhood. The scaling was a problem, but they solved it. Robinhood was burning a lot of cash in the beginning. Now they're very profitable. The VC mode concept, this is important that if you want to invest in these companies to be a unicorn, yeah, first is the key to find a mode. If they have a mode, advantage created through association with the top tier VC, component, brand credibility, talent, and leadership of the founder, media coverage, signaling power. You see almost in the news, a lot. OpenAI, for example. VC backed startups show higher survival and IPO success. Valuation dynamics in venture capital market. VC valuation are negotiated projects. So the VC will try to discuss what could be a good value, influenced by growth potential and TAM. Founder reputation and team equality. These are critical. And then leads to valuation inflation during hype cycles. So now we're in the hype cycles of AI. Now, if you have any AI idea, not any, most of the AIs, a lot of AIs, idea very hyped, valuation inflation, 2 billion, 3 billions. But at some point, they have to face reality. So behavioral finance and FOMO in VC, herding. Now we talk, people are talking a lot about unicorns. So we see herding a lot of money moving to type of unicorns. FOMO, fear of missing out. Like you want to buy the next Robinhood in a cheap value. Overconfidence, believe in founder magics, anchoring, overweighting prior valuation. You just didn't look at that. You say we see that a lot of in the quantum companies. Example, we work that over priced over $47 billion. Nah, but this company collapsed. So anchoring was a problem, and the founder was overconfident also. VC exit strategy. A lot of VC end up to be with the exit primary IPO. They sell to IPO and become to be public acquisition. Larger firm like Google doing a lot. Apple does a lot, buying companies before IPO and get them off. Secondary selling stakes to a later stage funds and exit timing critical to fund. Usually the exit happen before the IPO. Some people exit early also. Case study, Sequoia Capital funded 72 iconic VC firm, early investment Apple, Google, YouTube, Airbnb. Philosophy, long-term convention and award-changing ideas. And result, $1 invested in Apple 1978, worth 100,000 today. Global VC landscape, the US about 50% or more of the global VC funding. China state back innovation and AI focus. Also India fintech and logistic. India's booming. Unicorn in India. Europe sustainability and AI VC growth. Trend AI climate tech. Private tech is big these days, and quantum startups is huge. Quantum, huge. That takes me to policy and regulatory factor. Policy shapes VC success, tax incentive, IP protection, national innovation hub. These are the policy that shapes VC success. India doing a lot in this field. Example, Singapore, Israel, India actively support VC ecosystem. We see a lot of unicorn are in India. India should have a lot of unicorns, so 1.5 billion, big market. Challenges in the VC unicorn relationship. The challenge here is valuation bubble. Too much capital chasing few deals. Like everybody want to have unicorns, so too much money for unicorn, but not a lot of unicorn. Liquidity risk, long exit timelines, governance, founder control versus investor oversight, because when you put money, you want to oversight their work. Ethics, profit versus sustainability. Example, FTX collapse, governance failure, meet hypes. So that's example here of founder control versus investor oversight. The next frontier of fintech, AI, and quantum VC. In fintech, blockchain-based VC and crowdfunding. AI, automated dual intelligence and prediction. Quantum portfolio optimization with the qubits. The future of VC is data-driven, global, and interdisciplinary. Okay, now summary and takeaways. Venture capital is the financial engine beyond unicorn creation. VC success depends on timing, networks, and portfolio structure. There's a lot of behavior biases, so be careful from being FOMO or herd. Not everybody say this is a good company, you just go and buy it. The VC unicorn ecosystem drives innovation and volatility at the same time. Your homework is to answer these questions. How VC differ from traditional corporate? What makes VC model both powerful and risky? For example, here, should VC valuation face more regulation? I don't know. How can AI and fintech reshape venture capital itself? So I think we covered a lot about VC and unicorn this lecture. I hope you enjoy it. Just answer the questions that I just mentioned. Thank you so much and have a good day.